Most traders stare at charts desperately trying to predict the next move, but the truth is simpler. Smart money always leaves footprints. Clear, deliberate, and visible if you know what to look for. Picture this: price has been falling for days, retailers panic, sell at the bottom, volatility dries up, and suddenly the market begins to move sideways in a tight, quiet range. Volume contracts, then spikes only on down wicks. To the untrained eye, it looks like nothing is happening. But to a Wyckoff student, this is the silent handshake of smart money, accumulation. Later, the same market, after a long uptrend, begins to stall, spread narrows on rallies, supply hits every attempt to rise, and volume surges on down bars. This is no mystery. It is distribution, the quiet unloading before the markdown. When you understand these simple shifts in volume and price behavior, you stop guessing and start reading the intentions behind the tape, the very language Wyckoff mastered. Ladies and gentlemen, traders and students of the market, today we step beyond indicators, beyond predictions, and beyond the confusion that dominates most trading rooms. We enter the realm where price and volume speak with clarity, where the chart becomes a living tape, and where every movement tells a story of intention. Richard Wyckoff taught that the market is not chaotic. It is orchestrated by powerful operators whose actions shape every trend, every rally, and every decline. But the beauty is this: their footprints are visible to anyone who learns how to read them. In this session, we will uncover the simple yet profound method to identify the two most critical phases in any market cycle: accumulation and distribution. These phases are the blueprint of smart money. Their preparation, their campaigns, their silent operations behind the scenes. Once you recognize these structures, you stop chasing candles and start understanding why price moves the way it does. You stop reacting emotionally and start aligning yourself with the very forces that drive the market. Today, we decode the hidden language of professional money. We bring order to the chaos, and we unlock the ability to anticipate the market's next major intention, not through prediction, but through observation. In the Wyckoff method, few concepts are as transformative and as misunderstood as the idea of the composite operator ZCO. Wyckoff created this term to help traders understand the invisible, yet highly coordinated actions of large institutions, banks, funds, and professional operators. Instead of viewing the market as a chaotic crowd of individuals making random decisions, Wyckoff taught us to imagine the market as if it were being operated by one single mastermind. This composite figure has deep pockets, clear intentions, and the power to move price in ways the average trader cannot. Understanding the behavior of this composite operator is the gateway to recognizing accumulation and distribution phases with simplicity and precision. The composite operator behaves strategically when he wants to build a large position, far larger than retail traders can comprehend. He cannot simply buy all at once. Doing so would push prices up and attract unnecessary attention. Instead, he guides the market down, encourages fear, triggers stop losses, and waits until the public is willing to sell at lower prices. The result is the classic accumulation phase, where price moves in a range that looks meaningless to most traders. But beneath the surface, the composite operator is accumulating shares quietly, steadily, and without emotion. The hallmark signs include decreasing volatility, strategic volume spikes on down bars, and tests of supply to verify that selling pressure has dried up. Every bar, every wick, every surge of volume reflects his deliberate actions. Once the accumulation is complete, the composite operator begins the markup, allowing price to rise effortlessly. Retail traders, who previously panicked and sold at the lows, now chase the breakout. This emotional shift is intentional. The composite operator knows that public participation is needed to drive price higher while he rides his well-built position. But what is crucial for traders is recognizing when this campaign ends. Because at the top of a trend, The composite operator begins his distribution, the silent unloading process. Just as before, he cannot dump his large position on the market without crashing price. Instead, he sells gradually into strength, creating a trading range where rallies weaken, supply increases, and volume expands at the highs. The average trader thinks this is consolidation. The Wyckoff student understands this is the exit plan of smart money. The brilliance of Wyckoff's composite operator concept is that it trains traders to think like professionals rather than followers. Instead of reacting to news, indicators, or emotional impulses, the trader begins to interpret price and volume as reflections of intention. The CO is not a mythical figure, it is a metaphor for the collective behavior of professional money. And once you see the market through this lens, clarity replaces confusion, accumulation becomes visible, distribution becomes obvious. You stop trading noise and start aligning yourself with the operator who moves the market. Ultimately, recognizing composite operator behavior is not just a skill, it is the foundation of trading with confidence, precision, and a true edge. In Wyckoff's universe, the market is not moved by price alone, nor by volume alone. It is the relationship between the two that reveals the true intentions of smart money. This relationship is what traders call price-volume harmony, a principle that transforms ordinary chart reading into deep market understanding. When price and volume move in harmony, they tell a coherent story. When they diverge, they warn of hidden activity. By studying this harmony, traders can detect accumulation and distribution phases long before the market reveals its direction to the public. Price-volume harmony begins with understanding that volume represents the effort, while price represents the result. If the effort is large and the result is small, something unusual is happening beneath the surface. If the effort is small and the result is large, a new trend might be emerging. In accumulation phases, you often see heavy volume on down bars, yet price refuses to break significantly lower. This is a critical observation. It tells you that although sellers are active, buyers, specifically smart money, are absorbing supply. They don't allow price to collapse because they are quietly accumulating. When you see repeated instances of big volume on declines that fail to produce meaningful lower lows, you are witnessing price-volume harmony pointing toward accumulation. On the other hand, during distribution, the harmony shifts completely. You begin to notice heavy volume on up bars, yet price struggles to sustain higher levels. The public interprets this as bullish energy, but Wyckoff traders understand the contradiction. Huge volume with minimal upward progress suggests that smart money is unloading their position into public enthusiasm. They are not pushing price higher, they are selling into strength. The result is a slowing, stalling, and eventually weakening market. The harmony of price and volume whispers a clear warning. The engine behind the uptrend is losing power. Price-volume harmony becomes even more crucial when the market enters a trading range. This is where many traders get confused, but Wyckoff students gain major clarity. In the lower part of the range, large volume that produces little downside movement signals absorption, a sign of accumulation. In the upper part, large volume with little upside progress signals distribution. Each cluster of bars becomes a message. Each spike of volume becomes a clue about who is active and what they are planning. Smart money cannot hide their footprints because every transaction leaves behind a signature embedded in price and volume behavior. The principle of price-volume harmony also guides traders in detecting springs, upthrusts, shakeouts, tests, and other classic Wyckoff events. A spring without volume is suspicious. A breakout with no expansion in demand is weak. A test with extremely low volume confirms strength. A markdown with surging supply confirms distribution. Every event in the market is validated or exposed by the harmonies or disharmony between price and volume. Ultimately, price-volume harmony gives traders something more valuable than predictions context. It allows them to step into the mindset of the composite operator and understand the motive behind each movement. When price action and volume align, the story becomes clear. When they contradict each other, the truth reveals itself. And once you master this harmony, the market stops being a puzzle and starts becoming a language you can finally read with confidence. In Wyckoff's methodology, nothing is more vital and more misunderstood than the trading range. To the average trader, a trading range is a boring sideways market, a zone of confusion where price moves without direction. But to the trained eye, the trading range is the battlefield of smart money, the place where the composite operator builds or liquidates enormous positions. It is here that the market's next major trend is quietly engineered. Understanding the anatomy of a trading range is the key to identifying accumulation and distribution with clarity, confidence, and precision. A trading range is not random. It is structured, intentional, and full of hidden meaning. It begins with a stopping action, where the previous trend, either up or down, exhausts itself. In a downtrend, stopping action appears as a selling climax, where panic erupts and smart money begins absorbing massive amounts of supply. In an uptrend, it appears as a buying climax, where enthusiasm peaks and professionals begin offloading shares into emotional demand. This first boundary of the trading range sets the tone for everything that follows. It shows us where smart money stepped in to halt the previous trend. After the stopping action, the market enters the automatic rally or automatic reaction, depending on the direction of the prior trend. This move is natural. It is simply the result of the imbalance created by the climax event. The extremes of the stopping action and the automatic rally reaction form the upper and lower boundaries of the trading range. These boundaries act as the walls inside which the composite operator performs their operations. Price will bounce between these limits as smart money tests supply and demand. What makes trading ranges fascinating is that they reveal the intent of professional money long before the breakout occurs. In an accumulation trading range, you see signs of absorption, decreasing selling pressure, drying up volume at lows, higher lows forming within the structure, and occasional down wicks that smart money uses to shake out weak holders. Springs tests and secondary tests are all critical events that show the operator verifying that supply has been sufficiently absorbed. These events may appear subtle, but they are the fingerprints of accumulation. In a distribution range, the anatomy looks completely different. Instead of absorption, you see distributional behavior, upthrust after distribution UTDs, increasing supply at highs and lower highs forming as smart money unloads. The public sees consolidation and buys every dip, unaware that they are absorbing shares that institutions are shedding. Each rally is weaker than the last. Each decline is heavier. The trading range reveals that the composite operator is emptying their inventory while keeping price steady enough to prevent panic until their mission is complete. The most important element of the trading range anatomy is recognizing that breakouts and breakdowns are the final chapter, not the beginning of the story. Most traders wait for the breakout, reacting too late. Wyckoff teaches that the true edge comes from interpreting the structure before the market moves. The trading range is the market's blueprint. It tells you whether smart money is preparing for markup or markdown. Once you can read this structure, you no longer trade uncertainty. You trade intention, the very essence of Wyckoff's method. Among the most powerful pillars of Wyckoff analysis is the effort vs. result principle, a simple but deeply revealing lens through which traders can understand the true intentions of smart money. Effort is measured through volume, and result is measured through price movement. When these two elements flow in harmony, the market behaves logically, but when they contradict one another, the market exposes hidden forces at work, either accumulation or distribution quietly unfolding beneath the surface. This principle is the heartbeat of Wyckoff's method, and mastering it gives traders the ability to interpret market behavior with precision rather than emotion. Effort refers to the level of activity or participation in the market, the amount of buying or selling pressure present. Volume is the clearest expression of this effort. Result, on the other hand, is the actual progress the market makes in response to that effort. Large volume should ordinarily create strong price movement. If it doesn't, something is being absorbed or supplied by the composite operator. This mismatch is often the earliest signal that smart money is operating behind the scenes. Consider a downtrend approaching exhaustion. Sellers push aggressively, producing large volume on declines. That is tremendous effort. But if the result, the downward progress, becomes limited or stops entirely, it suggests that smart money is absorbing the selling pressure. Price refuses to fall despite heavy volume. This classic effort-result divergence is one of the clearest signs of accumulation. Wyckoff called this absorption, where professional operators take everything the frightened public sells. The result is stability at the lows, even though the candles may look chaotic. The truth is that the composite operator is preparing the foundation for a future markup. Conversely, in an uptrend losing strength, you may see increasing volume on rallies. The public believes this represents strength, but Wyckoff traders study the result. If the market produces little upward progress despite large volume, it indicates that smart money is selling into the enthusiasm. This is the essence of distribution: heavy effort, weak result. The public buys the top while institutions quietly exit. Effort vis. Result shows that the uptrend is hollowing internally long before it reverses externally. The principle also exposes manipulation. When smart money wants to test supply or demand, they often create deceptive spikes in volume or strategic bars. A sudden burst of volume with minimal price movement may be a shakeout or upthrust test, designed to confirm whether the opposing side of the market is weak. If effort is huge but the result is minimal, smart money has just verified that the time is right to move the market in the direction they intend. Effort vs. result is crucial in trading ranges as well. In accumulation, you often see decreasing effort, low volume on pullbacks, and strong result of firm rebounds, showing that supply is weakening. In distribution, rallies show increased effort, high volume, but poor result, weak advances, revealing that demand is drying up. Ultimately, the effort vs. result principle allows traders to read the truth behind price action. It removes guesswork and replaces it with logic. Every bar becomes a message. Every volume spike becomes a clue. When effort and result diverge, the market exposes its secrets. And once you learn to interpret these signals, you no longer follow the market blindly. You follow the intentions of smart money with clarity and conviction. In Wyckoff methodology, the market does not move randomly from one trend to another. It transitions through phases, each with a specific purpose and intention. These transitions are not sudden events. They are deliberate processes engineered by smart money to shift the market from accumulation to markup, from distribution to markdown, and back again. Understanding market phase transition is the key to reading the market like a professional operator rather than reacting like the average retail trader. Once you recognize the signs of these transitions, you can anticipate major moves before they become obvious to the public. A phase transition begins with the ending of one trend. A downtrend does not magically transform into an uptrend. It is first stopped, then stabilized, then quietly reversed through accumulation. Similarly, an uptrend does not instantly collapse into a bear market. It goes through a process of exhaustion, distribution, and controlled markdown. Wyckoff identified these transitions as the natural rhythm of the market, a cycle that repeats across all timeframes, from intraday charts to multi-year movements. In an accumulation, To markup transition, the market moves from phase A to phase E. Phase A is where the downtrend halts. Supply is overwhelming, but smart money begins to absorb it. Selling climaxes, automatic rallies, and secondary tests occur here. As the range progresses to phase B and C, supply is repeatedly tested and weakened. The operator shakes out weak hands, springs the range, and confirms that sellers have been emptied. Phase D shows signs of demand dominating. Higher highs, higher lows, stronger rallies, and increased volume on up bars. Finally, phase E marks the breakout, the beginning of markup, where price rises effortlessly because the composite operator has fully prepared the market. This transition is the moment where the true power of Wyckoff analysis shines. You are able to detect the shift before the breakout, not after everyone else jumps in late. In a distribution to markdown transition, the process mirrors accumulation, but in reverse. Phase A begins with a buying climax, where demand becomes exhausted. The public pushes price higher enthusiastically, unaware that smart money is selling aggressively into their optimism. An automatic reaction follows, then a trading range forms between clear boundaries. In phase B, the operator distributes inventory in chunks, testing the market's ability to absorb supply. Upthrusts, UTADs, and weakening rallies reveal the growing dominance of supply. Phase C often includes decisive upthrusts, intended to trap late buyers and provide liquidity for smart money to complete their exit. Phase D shows breakdown signals, lower highs, failed rallies, increased volume on down bars. Phase E is the markdown, where price declines swiftly because demand has been exhausted and supply overwhelms the market. Market phase transition teaches that trends begin long before they appear on the chart. The market does not explode upward because of a breakout. It explodes because smart money spent weeks or months preparing the foundation. Similarly, a breakdown is not caused by a sudden bearish candle, but by the silent unloading that took place beforehand. Understanding these transitions allows you to see the sequence behind the scene. You stop reacting to breakouts and breakdowns. Instead, you read the market's preparation. You align with smart money at the beginning of their campaigns and exit before the public even realizes a transition has occurred. In Wyckoff's world, phase transitions are not just chart patterns. They are the footsteps of the composite operator, revealing the market's next major intention with remarkable clarity. In the end, the art of identifying accumulation and distribution is not about prediction, guessing, or relying on complicated indicators. It is about reading the intentions of smart money through the footprints they leave behind. Richard Wyckoff's teachings guide us to see the market as a structured, deliberate process where every trading range, every volume surge, every tightening candle, and every failed breakout is part of a larger campaign orchestrated by the composite operator. When you understand composite operator behavior, price-volume harmony, the anatomy of trading ranges, the effort vs result principle, and the flow of market phase transitions, you no longer view the market as noise. You see a story unfolding in real time. Accumulation is not confusion, it is preparation. Distribution is not consolidation, it is liquidation. Trends do not appear from nowhere, they emerge from carefully engineered transitions. The public reacts, but professionals anticipate because they understand the sequence. And now, with these principles in your hands, you are equipped to step into that same mindset, to stop trading randomness and start trading intention. Your edge is not in predicting the next candle, but in interpreting the deeper narrative behind price and volume. When you align with smart money, patience replaces fear, clarity replaces confusion, and decisions become deliberate rather than emotional. This is the true power of Wyckoff's method, and it is now a power you can carry into every chart, every market, and every trade you make.